very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. So how are we doing today? Is everybody in a good mood? It's been a funny week. We got the Fed coming up shortly. The indexes are collapsing as we speak. I don't think they're that bad, actually. It's been kind of a crazy day so far. The S&P has really come down hard from where it was. And the Dow is slipping, the NASDAQ slipping, everybody's slipping, but back to 14,000. We're going to keep testing that line for a long time. And you got 23 on the Russell, 42.25 on, it's just 42.20 is the line we kept looking at anyway. And pretty much the 34,000 line on the Dow. So nothing wrong with this. I mean, we don't want to keep going up because it's just crazy and things are so overpriced. So it's better to consolidate a bit. If these are real levels, we just consolidate for a year would be great. I can't have my sandwich and talk. All right, so I mean, this thing all day. All right, where are we? Oh wow, look, oil came back down hard. Oil went all the way up to touch 73 and came back down to 72 now. Oh, we'll get to see. We'll take a look at the EIA report. Let's have a look at what that says. Now we're still too short. Oh, this isn't right. This is broken. This is from last week. It needs to be restarted. La-di-da. Oh, I can't do that now. It's going to mess up the webinar. Anyway, all right, so it doesn't matter. We have two shorted with an average of 71 for oil. So we have to, and I just said to the members before, I said, look, if we get back to 71, I'm just going to take it off and quit because we're too close to July 4th, and you can get to 75, you can get to 80 on the July 4th weekend for no reason at all, not because anything happened, just because it's a holiday, it's going to be short, there'll be very few trades. They can make up bullshit stories, and they'll do whatever they can to jack up the price of gas, because it's not just on paper. This dictates what you pay for the gas that you're buying. So if they can jack up the price of oil by $5 into the July 4th weekend, you're going to pay $5 a barrel more for oil that you actually purchase. You're forced to pay $5 more because they jacked up the price during one session of the NYMEX. And we consume 20 million barrels a day. So that's $100 million a day is on the line by doing this. So if they lose a few $million pushing these trades out, who cares? The guys backing up these traders are the same oil companies that are profiting off of their activity. That's what the NYMEX is for. It's there to jack up the prices. It's supposed to be there to set prices fairly, but that's not what it does at all. It's how they control the market and manipulate the prices. All right, so meanwhile, obviously the big topic this week, aside from the Fed coming up at 2 o'clock. Oh, I'm sorry, we're going to look at the oil report. So last week, this is the June 4th report. We want the June 11th report, and there it is. This week it's on time. Last week it was real slow. So this is a week ending June 11th, and June 11th was Friday. So these things, they used to go to Sunday or Saturday. Now they go to Friday. We're not quite sure how that happened. But June 11th, this goes through. So, basically the holiday was this weekend. So this is quite a bit after the holiday. Everybody would have come home, filled up their tanks by now, right? So that's where you are. And as of June 11th, we had a draw in oil of 7.4 million barrels. And that's a good size draw. That makes them happy. But the thing is, gasoline increased by 2 million barrels. We're still not getting the usage that we had. We're still not getting anything like the usage that these guys expected. There's really no indication that there's a lot of demand. Now, look at the product supply. We're up to 19.3 million barrels a day is being supplied. Last year was 16.4. So the change is 3 million more barrels per day, which is up 20%. Excuse me, up 20%. We're still exporting 2.5 million barrels a day. Petroleum products are being exported. So of this 19.5, same was true last year, though. We were exporting last year, too. Of the 19.5, we're only actually using 17, basically. So we're really using 17 million barrels. We're not using 19 million barrels. That's not our demand. That's export demand that we're taking care of for other countries that don't have the refining capacity that we do. Now, also the net build or draw in oil. Sorry, the net draw. We went from 19.8 here to 14.3, so 5.5 million barrel draw is the net. All other oils had a slight build. That's part of it. That's hidden in there, and the rest are what they set up here. Nothing exciting about here. Certainly nothing that dictates you should be over $70 for oil. But again, it's too close to the holiday, and there's too much money on the line for them to not try to keep prices up as high as they possibly can. You look at this oil chart. It was $66 the last holiday weekend. Now it's 72. So coming into July 4th, they're now getting $6 a barrel more times 20 million barrels a day is $120 million a day more money for their oil than they got last year. Not last year, I'm sorry, last month. Last year, we were down in the summer last year, we were down at 40. But let's say that's artificially low. But why are we at 72? There's no good reason for this. This is silly. All right, that's where we peaked out in 2018, and then we crashed from that. And then this was a virus crash. But the reality is, even with a good economy, even with things going well, strong market, everything else, we were below 60. There's no reason. Not only do we have plenty of oil and we're well supplied, but OPEC has millions of barrels of spare capacity they're not even using. So the only reason there's any kind of draw at all is because they're withholding the production of the oil. It's all artificial. There's no natural shortage of oil. So there's no reason oil should be at this kind of price hikes. But nothing you can do about it other than, bet against it. But you can bet against it, but you don't want to bet against it and say, oh, I'm going to ignore July 4th and everything else. No, it's coming into the holiday. It's just too dangerous a bet. It could fly up to 80 before it goes down, and that would be miserable, and you lose $10,000 on 2 contracts. So why bother? Take the loss, go home, trade some other time. So what else is happening? Ew, why does that look so weird? That's kind of strange. Oh, because it's all blown up. What? No, it's still weird. I'm stumped. I don't know why everything is so strange. Let's see if we can reset this. Now it's too small. There we go. That looks normal. So today we were talking about prices. The final demand PPI, that's what you actually pay for stuff. And for goods, we are at 11% inflation. Services are at, now, I don't know why services are up at 5%. We're paying a lot for services too. That's shooting up. But the goods at 11% is really scary. But what's even worse is the intermediate goods, because the intermediate goods is the stuff that you're going to use to make next month's final demand. And those are this is plus 60% from last year. That's because, you know, copper has doubled, oil, as you see, is almost doubled also. The raw materials, the inputs that we put into our products are all flying higher. At some point, that's going to get passed in. Now, you have to then look at what percentage of the price somebody pays are the goods and materials. Now, in an iPhone, for example, I think the cost of the parts of the iPhone is like not even $600. Cost of parts of iPhone. I guess I have to determine which iPhone. All the parts manufactured for the iPhone is $490. So yeah, $500, probably more by now though. When's this from? Yeah, it's from 2019. So haha, my number's correct. All right, so it's about $600 for all the pieces that go into making an iPhone. So the iPhone sells for what, like $2,000? How much? Okay, no. How much is an iPhone 11? What? How can it cost $699? That's not right, is it, guys? I'm thinking like $1,000-something. Serious? Oh, it's a max. All right, let's. All right. I don't think it's gonna make that much difference. Max. 750. Why? Is that? Oh, is that because we have the newer models now, and these are old, and these are considered old? Anyway, bottom line is, okay, so it depends on the manufacturer and how much is parts, how much is labor, and so on and so forth. And that's going to come into account for inflation, because that's why obviously services aren't going up as fast as goods. But meanwhile, there's no way to avoid it. I mean, you know, you think about whatever job you have parts, you have stuff that needs to be done. And there's input costs, and those input costs are going to have to at some point be passed along. So if the labor costs are going up and the goods cost is going up and your materials costs are going up, eventually you're going to have inflation. And this is going to have inflation more so than we currently have. And the only way you can fight inflation is by raising interest rates. The Fed has to rein it in. The Fed is so unwilling to do that, unable probably to do that. And this is where we get back to this statistic I was talking about. The PE ratio of the NASDAQ is now 43 at the 14,000 mark. So it's at 43 times earnings. So you divide 43 into 100, it's 2.32%. So that's the return on your investment. If you're getting 43 times earnings, you're basically getting the same as getting 2.32% interest on an investment. That's how much your stock is making per year in profit. That's also the yield of the 30-year note. So right now, people would rather have, all things being equal, the stocks are paying as much as bonds. So people are putting their money into the stocks because the bonds are paying crappy returns. But when the bonds, you know, if the Fed rate hikes half a point to 2.5%, okay, what's going to happen? Then the bonds will be a better investment than stocks, which are only returning 2.3%. That means the stocks would have to balance out. And now for the stocks to go to 2.3%, that would be, I'm sorry, for stocks to go to 2.5%, would have to be 40 times earnings. So the NASDAQ would have to pull back to 13,000 to follow the Fed. So a half-point Fed hike is going to chop 1,000 points off the NASDAQ. and we'll be back to where we were in the slump in May. Not that the Fed's going to hike a half a point, but once they start signaling the intention, then that writing is going to be on the wall. Then you've got to start handicapping the market, and that's all else being equal, of course. There's also a lot of irrational exuberance in the price of the stocks in the first place. So, that's why we're not buying a lot of tech stocks. They're too much, but everything, even the entire S&P 500 is trading at roughly 35 times earnings at this point. I mean, it's just, it could be a little misleading because a large portion of that is the out of control tech stocks that make up the S&P 500. So they have a huge weighting because there aren't any other trillion-dollar companies. Microsoft, Apple, Google, Facebook, I don't know, whoever there's, those are the trillion-ish companies. And there are also the tech stocks. So the NASDAQ 100 is very concentrated in those companies. But honestly, they're not really the problem. Well, Amazon sure is with its 60 times earnings. But Google, well, it's not nothing. Google is, well, backward looking 75 times earnings. That's not fair though for them. That based on last year, I think. So Google 1.6 trillion, and they should earn about 60 billion, and so that is 1600 divided by 60. What? None of that worked. 16 number lock. 1600 divided by 60. 26 times forward earnings. So Yahoo's being very unfair. And it probably says that here somewhere. Where do you have PE? Oh, PE 26.7. Yeah, there you go. So Microsoft, hopefully more reasonable. No, Microsoft 31. See, that's wrong. These are wrong numbers. They shouldn't be like this. And Apple is probably about 20. No, actually, Apple's probably getting up there too. Whoa, what? PE ratio 8.8. No, that's Alcoa. That's why. Ooh, let's buy Alcoa. We already bought. We bought the other part of Alcoa. We didn't buy Alcoa. There they are. 24. So I mean, 24 is high for Apple. Apple's usually at like 15, and not that they should be at 15, but historically they tend to sit around the 15 area. And not that they should, going from 325 to 354 to 368. This is almost as much as Walmart's total sales. It's crazy. Or Amazon, who is now catching up to Walmart as far as total sales. Profit 76, 86. Oh no, I'm sorry, it's not here. It's 57, 86. That's crazy. But then 86 holding steady next year. But this year is going to be a huge year for them. That is just an insane amount of money. It really is. So, these are the trillion-dollar companies. When you have one, and you got one company that's $2 trillion, that's way out there. So this is why we're getting these valuations. Even the mega caps are trading at 25, 30 times earnings. That's extremely unusual. I mean, unusual in that it makes no sense at all and it's crazy and it can't possibly be sustained. But other than that, it's fine. So one day, what's going to happen? Because if the Fed keeps their rates low, like they are now, then inflation goes out of control, and the economy will start falling apart, as it is with housing, because now the average house in America is $350,000. In 2008, it was, man, believe me, we know this number because it was like extremely important at the time. It was 250, or even 220 something. But so housing prices have gone up 50% in 10 years, 5% a year. That's not crazy. That's not abnormal for housing prices to go up 5% a year for 10 years. But wages have not kept up in any way, shape, or form. Wages have been pretty stagnant. Now they're raising the minimum wage, but that really isn't going to put a dent in the housing market. And they're complaining that homes aren't affordable, but they're not affordable because wages aren't keeping up, people aren't getting the raises, and so on and so forth. Wages by year. U.S. wage growth. Let's see what we got. Well, that's tricky, isn't it? But anyway, as you can see, though, since the crisis, we pretty much hover at 2.5% annual wage growth. That's where we mostly are, is 2.5%. We don't really get up very much. There was this little spike when they raised the minimum wage, and that gave us a big spike up when they changed the law on the minimum wage. But now we're back to our normal crappy wage growth. And it's just not enough to put you, how are you going to afford it when the house is climbing at 5% and you're at 2.5%? How are you possibly going to be able to come back and buy a house? That's why what we're looking at here, where was it? Housing. Here's why we never came back to the levels we had of housing starts. It's hard to afford a house. Not only that, though, but we've had two big events. Here's May 9th, and now we have the COVID that have really eaten into people's savings and buying power. And I know people have a lot of savings, but it's a different kind of savings when you talk about what they have ready in the bank and so on and so forth. Having the kind of savings that you need to deposit, make a home deposit, is very difficult for people to put together, and especially with so many people who had diminished salaries and so on and so forth last year, that ate into the money they would have been spending to buy a house. So that's why the realtors are lobbying to get the government to do something, which is frankly what I was doing. I mean, I was lobbying for this in 2008. I said what the government needs to do. And I actually, this idea was good enough where I actually got invited to meet with Geithner at the time, the Treasury Secretary. I sat in the Fed and we talked about this. But the idea is that government would take $100,000, would give you basically all you have to do is sign a one-page paper in the bank and say, I'm borrowing $100,000 from the government. The government will get the first $100,000 back out of the house. So the government's basically lending you $100,000 against the value of your home, becomes a partner in the home with you, and will collect their interest also at the time you sell the house. So until you sell the house, it's fine. Even if the bank forecloses though and sells it, government still gets their money. But this way, everybody can afford a home because you're going in with a party. You've got to pay. You've got somebody lending you the deposit you need for the house. The government's going to put in $100,000. Also, people who wanted to take $100,000 out and refinance their home and use the equity that they did have, you do the same thing. Just go to the bank, sign a piece of paper, say, okay, the government gets $100,000 worth of my house. Boom. As long as you have $100,000 worth to give, you can have it. That is how you stimulate an economy, because then people are actually doing it themselves. The government has an actual asset, not a fake asset, and has what would be now about one-third of the average house will be owned by the government. That's fine. The government has a vested interest in maintaining your home's value and so on and so forth anyway. So it's the simplest way to give money to homeowners and to make home ownership easier for people. So that's been discussed in detail as a plan. They're trying to now reintroduce that with Biden. And of course, Biden was the vice president at the time we talked about this plan in the first place. So, if you want to kickstart something, you do it that way. Some of the crap they're talking about now, though, is just downright silly, and they're talking about banks, guarantees, and things like that. It's like, stop giving money to the banks. Give it to the people who actually need the money. There's no, giving it to the banks and making it easier for the bank to lend you money and charge you interest doesn't help the homeowner. You know what helps the homeowner? If I have a $300,000 mortgage and it becomes a $200,000 mortgage because my government partner puts in $100,000, then I'm only paying off a $200,000 mortgage. I have a much easier time making my payments, and when I go to sell the house, I'm going to get my partner will take his third, I'll take my 2/3. when we sell the house. That's perfectly fine. That's a good, fair system. And I'm back to lobbying for it, but I mean, that's what we need to do if we want to stimulate the housing market properly. Because you're still going to buy this house, you're still going to go do everything you have to do to qualify, you're still going to take care of it, you're still going to own it, you're still going to benefit from it down in the long run. These are all good things. That's how you build up more of a housing economy. But my main point up here, though, was that, not here, where did I say that? Units, 90%. Oh, yeah, here you go. It's down here. So in 2008, so in 2008, we had 130 million homes. Okay. Now we have 140 million homes. So 10 million more homes have been added over the course of 10 years. We've added 10 million homes. We also grew the population by 23 million people. So we had 230 million people. No, not 230. I'm sorry, 308. What am I talking about? We have 308 million here, and now we have like 331 million people. So we grew 23 million people and 10 million homes. So therefore, 2.3 people per home. Before that, we had 308 million people and 130 million homes. Therefore, 2.3 people per home. So what the National Association of Realtors is talking about is bullshit. There's nothing, and this is a problem with statistics, because you look at these articles and you read these statistics. Let me see where this started. Oh, I'll open that up. Open in an incognito window. Okay, so the U.S. housing market. This is the headline of the Wall Street Journal. You know, you try to think that they're like going to be on top of things. Let's see if it's still in there. Is it still the headline? Yeah, here you go. Look at that. Wall Street Journal News exclusive. Housing market needs 5.5 million units, says a new report. Yeah, you know what they don't tell you? The new report is by our sponsor, the National Association of Realtors. They're big, obviously big advertisers in the Wall Street Journal. Realtors have big sponsors everywhere. So they get to control the narrative and tell you what's going to happen. And this report is extremely friendly and unquestioning of what they're saying. So the National Association of Realtors does a study, declares an emergency, lobbies Biden's administration to do something to make it so more people can buy houses. But meanwhile, the same 2.3 people per home exists now as existed 10 years ago. And you know what happened 10 years ago? The whole market collapsed because there were more houses than we needed. That's never corrected. So, and frankly, I think with the aging population and stuff, I don't know. I'm not sure if they count, like, you know, if your grandmother's in one of those nursing homes with like her own little apartment. I don't know what they call those, adult communities. But you know, I don't mean like a senior. I don't mean like a place where a lot of old people live, like my mom lives. She's 80. I don't mean a place where they're independent on their own. I mean the places where there's like nursing staff, but each person goes to their own little apartment and they come out and they do their group activities and whatever in the nursing homes. Assisted living, I guess that is. I don't know if that counts as a home. So I'm not sure how the math works, but I think with more and more people heading into those things, with an aging population, the baby boomer curve, everything else that we have going on, I don't see where we have this need for that much more housing units. We're not growing the actual population fast enough to justify this big bump. These guys want to get back to this, where there were 2.2 million homes, or over 2 million homes being built every year, brand new homes, and now we're at 1.6, so it's about 30% less. And they want to get back to the glory days where people were being a realtor is like a top-notch job, and it's not. Mortgage broker too. Being a mortgage broker used to be a fantastic job. It's still not terrible, but it's not where the top earners are going to be. So they want to get back to the glory days, and they're lobbying for it, and they're commissioning studies. They're doing everything you're supposed to do if you want to promote your own industry. So kudos to the National Association of Realtors for doing their jobs, but they're doing their jobs by trying to bend public policy their way onto false premises And that's the problem then. The financial press will go along because they sponsor that financial press. So those guys go along. And then they lobby Congress, and people think it's true because they read it in the Wall Street Journal and blah, blah, blah. It's ridiculous. It's very unfortunate that this is the way we conduct our policies. Real estate is the top investment in the Tiger 21 quarterly survey. It just said on CNBC. So there's a full court press for the real estate market right now. But the problem is with materials and crap, $341,000 is more than people can easily afford. More than, you want a lot of people to buy a home. Don't charge $341,000 for it. Damn. That's got to be, well, with these, see, that's the thing, with these rates, it's probably not that much money. Calculate mortgage payments. So you're purchasing a loan in 33444 in my zip code. Are you a veteran? No, I'm not. My credit score, sure, why not? Really? No, I'm not. See, they're making it too hard. Here you go. Mortgage amount. So let's say $300,000. The interest rate at 4%. Is this instantly changing it? Wow, seriously? If I go to 2, oh wow, that's a cool calculator. So $300,000 is $1,400 a month, not including taxes, of course. At 3.92%, I'm not sure what the rates are now. I don't think they're that high, frankly. But if the rates go up to 5.92, it's $1,700 a month. It makes a big difference. So that's why, right now with the rates low, and I think they're more like 2.92, a $300,000 home isn't that terrible. But once the rates start ticking up, they're going to have a lot of trouble moving these homes at those prices. People just can't afford that kind of money. And again, you got your taxes, utilities, and everything else they got to pay for to do that stuff. Look at this. Worker share of corporate income used to be 80%. I don't know if it's 80%. That doesn't make sense. Labor share. Share of corporate sector income received by workers. This does not even sound correct to me. But anyway, it's still down from 80 to 77, but it just something's not right about that number. Cumulative hourly earnings and hypothetical if they had grown 3.5%. So in other words, even that, so this is how far behind in the gap we are from 3.5%. 3360 or 30.33. So we're about 10% behind overall in wage increases over this period of time. And that's what I mean. So we're 10% behind in wage increases that should have been there, but even that is not even coming close to keeping up with the house price, which went from 250 to 350, which is way up here. So you're basically, so people are, so another 10% above that is where you are if you're trying to afford a house. And so we're 20% behind what we need to be to be able to afford the same houses as we could afford in 2008. So the persistent inflation at the levels we're seeing now is going to start impacting the consumer's ability to spend, and that's what causes a recession. And then people stop spending. They can't afford their homes. Also, property taxes are through the roof. That's an interesting thing. I don't know if there's a way to do that, though. Property tax over time, because every state's different. Property tax in the United States. Well, This is Orange County, for example. Okay, so local government annual property tax revenue in 1980 was $20 billion. In 2000, it was, what is that number? $35 billion. Now it is, literally in 2000, in 2020, 20 years later, $55 billion. So we went from 35 billion to 55 billion, 2/3 increase in 20 years. That's nuts. And what happens when this happens? What the frick is that one? Wow. Greatest Springfield. That's where the Simpsons live. Oh, total U.S. property taxes in constant dollars. Well, that's confusing because you can't tell what that is. But yeah, here you are at 2000, you're at 350. Here you are again, 550. It's the same thing. I mean, this 20-year period has been killer. So when the property taxes go up like that, they devalue your home, because when somebody's buying the home, they're buying the mortgage and the taxes that they can afford. If they can't afford the mortgage and the taxes, the only flexible part is your home price, because the your local state and city government's not going to bend on how much they're going to collect. So the money, if you want to sell your home, comes out of that. So what's happening is the government, with this property tax increases, have been stealing the value of your home. The amount your home should have increased has been stolen, because it's being now forced into paying more taxes than you used to pay when you started. Now, what's going to happen is we're going to start seeing, well, I should have reset this. Log in. What's going to happen is you're going to start seeing people cut back on big ticket items. Auto sales are going to suffer. You know, inflationary items that people can put off, like durable goods, basically. We're going to start seeing problems with durable goods. Oh, here we go. So let's keep our eye on that stuff. And we'll see what the Fed has to say about it. But the point is, if the Fed keeps the inflation, if the Fed keeps the interest rates this low and they allow inflation to keep running high, what's going to happen is that we're going to push into a recession, because people can no longer afford the goods and services, and therefore they're going to stop buying them, cut back, do whatever, and that's going to give you a recession anyway. So you get to a certain point where it doesn't, the Fed policy of lowering rates no longer stimulates the economy, because you've already pushed people too far past the brink. And this is what happens. This is how you collapse an economy, with too much borrowing, too much spending, and too much inflation. So you sort of in fact, there's by Hayek said that you're sowing the seeds of your own destruction. So in other words, your policies is sowing the seeds of the future destruction of the economy. So trying to help it is not the thing to do. And Hayek was more laissez-faire, of course, but he makes the point that all this stimulus and trying to pretend that you can avoid economic cycles is bullshit. Economic cycles exist. You're going to go through them one way or another, and by putting it off and putting it off and putting it off, you just make it worse when it comes. Instead of having like a normal pullback, you have a tremendous crash. We're going to hear what the Fed has to say shortly. Let's see if there's any questions. No questions. Okay, good. I must be doing a fantastic job. That's the only possible conclusion. Yesterday, we looked at the short-term portfolio. We made a couple of adjustments. So here's our short-term portfolio, which yesterday was 242. And let's see where we are today. Oh, way better. 262. We made 20,000 bucks in a day. That's very nice. I didn't change anything yet. The changes that we made didn't go into effect. Just had a good day. And that's because we pulled back yesterday and we pulled back today, so I guess that's inevitable. So that's the swing though. That little pullback we had was good for 10,000 bucks in, I'm sorry, 20,000 bucks in a day. This is what we have. We talked about making some changes to CMG. We talked about making changes. Did CMG go up or down? Where are they? Not so great. We talked about adjusting FXP, TQQQ. We're making an adjustment to, got a little more aggressive on that. SQQQ, we made a small adjustment here also. All these adjustments are positive, so we should be doing pretty well. Oh, look what happened at W. Wegman, not Wegman, Wayfair. So Wayfair took a tumble. That's nice. And what do we do here? The short 320 call should go worthless. So fine, I left that. So I'd rather sell 3 November 340s, which we did, and thank God we did that before they crashed. And that paid for rolling the 300 puts to the 350 puts. And we sold the 250 puts as a backstop to pay for that. So we've got a really nice wide spread here. This thing can make a fortune in the end. And what we've done is just keep adjusting it as time goes on. You know, I forget when we started with it, but we, I'm not sure this is going to be. Yeah, so back in March is when we started this trade. So in March, when in March? I think it was after they had that big spike. March 15th, yeah. So where was I? So March 15th, after they had this idiotic spike, is when I started shorting them because I was like, oh my God, come on. It's a freaking furniture company trading at like, 50 times earnings. So we started shorting them here. We had a big up and down ride, but what we've done is we kept taking advantage of every dip and every trough. And so when it gets up here, we sell something else. And when it gets down here, we buy stuff back. And we've been doing a very good job of managing this trade. It's been a nice little money maker for us, even though very volatile and annoying. But if you have the margin to deal with stuff like that and ride these kind of things out, it's kind of fun. You also just have to have the conviction, though. If you're going to be, the thing is, if this is a long period of time. This is March, April, and May. So, if you come in, if you're wrong at the moment, if you're wrong and you catch it at the wrong time and it goes up against you, if you're going to panic out here, don't even get into the trade. You got to look at the history of a trade and see how volatile it's been, and then say to yourself, when it's here, you say, well, this thing could easily go up or down $100. So when I'm here at 280, I don't care how strong my convictions are, or we came in maybe at 320. I don't care how strong my convictions are that it was a good short, but you have to accept the fact it could go to 420 or it could go to 220. And if you were not prepared to deal with that, when you start the trade, don't start the trade. Don't to think that it's not going to do what it just did is ridiculous. It's clearly capable of making moves like that. Look at this ridiculous spike over here. If that's going to stop you out, this is not a stock for you. You have to be ready for that sort of things in these trades. So we've been doing, this has been growing great for us. Fortunately, we haven't had anything that ridiculous, but it does happen in this stock. And when it does happen, instead of stopping out, you have to say to yourself, okay, we're going to wait for this thing to calm down. Then we're going to sell something. We're going to sell some freaking calls at this kind of strike. And if I had already sold calls, I would have rolled the calls up to some ridiculously high strike and sold some more there. But you got to have a plan for what you're going to do if something goes up and down 25, 30% on you. Otherwise, you shouldn't be in it. If you can't afford to deal with it and make the necessary adjustments, don't do it. So as it turns out, we have 320,000 of downside protection. The way we calculate that is the net of the spread currently and how much the spread would be if the market drops 20%. I don't care how much the net of the spread is. That's not relevant. What's relevant is how much would the spread be taking the cap into account if you're capping it out, but how much would I make on the spread if the market drops 20%? That's what's real. That's what we're hedging against. Getting caught by an event where the market goes down 10% in a day, and then it goes down another 10% by the time it opens the next day or something like that. Or like in 9/11 when trading was basically halted. And frankly, in 2008, you couldn't freaking trade anyway. The exchanges kept going out on us. It was so hard to like adjust and do stuff. So when when the market's really crashing, you can't even count on being able to do anything. So that's why we picked 20%. 10% is a limit for the day. 20% is very unlikely 2 days in a row you're going to limit out on the stock market. And so we can adjust after that point. These hedges, though, however, they'll make more money up to 40%. They'll probably be $500,000 in protection. But as it is now, we have 320,000 in protection we can seriously count on in this portfolio. So this portfolio will go from 250 to almost $600,000 if the market really collapses. Then we cash that out and we would start buying longs. But here the question becomes, what are we protecting? And so in the long-term portfolio, and these numbers are a bit off because, well, first of all, it doesn't have the new stuff in yet. Total, there's no options. The stock is new. They changed tickers. Nothing else changed, but they changed the ticker and they voided all the old options. You have to now have the TTEs. They don't accept the TTE inputs yet, so I have to wait. But anyway, so we're up to 1.9, almost 1.95 million on the long-term portfolio. We've got, now we have 12 short puts. We've been adding, oh, there's the other part of Alcoa is trucks because they split up. So we do have that, we just don't have Alcoa. We've got all these solid things, but you'll notice that what we don't have is tech stocks. Alibaba, we do like. We have Alibaba, I think we have Facebook, but here's, Big Lots, Berkshire, China Mobile, I don't know what you call it, tech. That's broken too. We should be really better on this one. So we're showing $19,000 loss as if it's a zero. All right, Cisco's tech stock, but barely a tech stock. It's a appliance stock. I think a router is kind of more like a dishwasher, right, than a tech item. We've got Facebook, Foot Locker, Gilead twice, Gold, Goldman Sachs, IBM, okay, tech stock, and again, more like a utility. IMAX, Intel, obviously tech stock. Actually, we do have a lot of tech stocks, so take it all back. We have tech. We have Lloyd's, we have 3M, we have NRG, Plains American Pipeline, Petrobras. Oh, I forgot about Petrobras. How are they doing? That one's all right. It's doing okay. They're above our target, so that's good. Pfizer, we got PHM as a home builder of all things. After I was just dissing the home builders, we have QSR. We have Reynolds. They're okay. SKT is fantastic. SunPower, fantastic. AT&T. UBS, Viacom, VLO. So as you see, anyway, we have some tech stocks, but not heavy into tech stocks. And these are very, very stable, blue chippy kind of companies that we like to play in the LTP. But the bottom line is we have $1 million worth of securities. We have a $300,000, don't forget, protection against a 20% drop. A 20% drop in the LTP, 20% drop in the market would hit the LTP for more than 20%, probably 40%. But we only have $1 million tied up in the securities, so we'd probably lose about $400,000 and make about $300,000 back in the STP. So our risk is probably about $100,000 if the market crashes 20% on us. That's really not a big risk out of a $1.9 million portfolio because we're sitting on $1 million in cash. So we don't feel that we have too much risk. We've added more positions, which I have to input here before we do our long-term portfolio review. And we're just going to be very, very careful about what we play. But we do need more longs because the market stubbornly refuses to go down. And even what we're doing right now, even today's action, these are not terrible. This is 3.9%, 2.7%. 0.57%. These are not big moves down. They look big because the market hardly ever goes down at all. And we're like, ooh, it went down. But it's really not a big deal at all. So, we have to defensively keep adding long positions because we are otherwise going to be falling behind on the inflation front, right? We got a, oh, wow, holy crap. Really? 437%? That's crazy. Is that accurate? I think I say that every time. Well, the butterfly portfolio has been running since 2018. That's one reason. So it's it's way ahead of the other portfolios based on that. Yeah, none of these is zeroed out or anything. That's pretty crazy. We had a good month with the butterfly portfolio, I'll tell you that much. So we're not worried about that. The dividend portfolio, much mellower, I'm sure. Still 95% for the dividend portfolio. You know, this is from October 2019. These are pretty good. The earnings portfolio, 211%. That's pretty damn good considering that's from 2019 too. And again, see, notice security value, $80,000, so much cash. And the earnings portfolio even has an SQQ hedge in it. So the earnings portfolio is actually hedged. The hedge itself, well, it's kind of misleading because of the rolls, but you know, we have the October, we have the $30. Oh, I see the short calls. No, we sold a ton of short calls and we crushed it. We sold $69,000 worth of short calls. That has paid for this whole position. Because the position was on 416. We have this position for $30,000, right? The 517 bull call spread was net $29,000. But earlier on, we had sold all these short calls, and they paid for that. So this is like free insurance in this portfolio. That's really nice. That's always a good strategy to play, but you have to just be very careful about your timing. You have to watch yourself and make sure you're not overexposing. Future is now also doing very well, 106%. It's amazing how, you know, it seems kind of obvious to us because we pick these very simple things, like we pick the airlines to come back, and you know, it's just these are very simple bets just based on where things are going. Oh, how are these waiter guys doing? No, not so good really. That's our newest one. So we pick these very simple trades that we think are going to do well, and that the market is changing their direction. And generally, we've been getting hits all over the place on these. And that was also, these were all about the same time in early 2019, late 2019, that we started these. And the other one is, of course, the Money Talk portfolio. And now that's up 100% too. So that's had a good month. You know, and the question is, when do you stop? Now, this one I can't stop because I can't do anything about it till I'm on TV again. But so this is a good example too. Here's a portfolio we can't touch, not allowed to change anything unless I'm on TV, and that's only once a quarter for the show. So what do we have in this one? The ones you're sick and tired of me talking about, right? Barrick Gold, IBM, Intel, Pfizer, Tanger Factory Outlet, SunPower, and Viacom. Okay, if you had to say that, what stocks does Phil talk about the most in the course of a year? Those are them. And we established this cute little portfolio that's up 100%. Again, simple, basic trades, not touching them, not playing with them, not screwing around. So that's what we're doing. Oh, how's the Fed time, right? You know. Okay, FOMC. Fed statement. That's not it. That's their last statement, March 17th. Ooh, there it is there too. Don't need two of those. What's New York Times have to say? So Putin and Biden had a chat. Oh, wow. Look at poor Joe after meeting with Putin. What's up, man? He's tired. What is this guy doing? Oh, I see. He's holding his two hands I guess that makes the phone steadier. Is Putin? Yeah, Putin's in great shape, huh? Biden, he looked okay there. He kind of fell apart though later. At what point does Biden lose it? Oh, that's Trump. How did Trump sneak in there? Oh, look, Clinton's tall, huh? Oh, Putin's short. All right, so. I don't know, he looks really frazzled in that thing. Putin said the meeting went well, but their comments to report a suggested divisions remain. Putin said he had nothing to do with the cyber attacks, blah, 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 normal crap. All right. See this housing issue? Why Americans, women everywhere are delaying motherhood. Birth rates have led to the slowest growth of American population since the 30s and the change in motherhood. That's what the National Association of Realtors needs to address. They need to get people having babies again. Actually, I'm sorry, they are doing that. They are doing that in the Supreme Court. They're making it illegal to have abortions. That's how you increase the population. Doesn't matter whether people want the kids or not, just keep having them. U.S. surpasses 600,000 virus deaths. Well, that sucks. Where inflation stands as the Fed meets. All right, we should have the minutes by now with a statement. Nope. We will keep hitting refresh until somebody does something. Where did my CMFP go? Bloomberg. Bloomberg Media. See if Bloomberg gets it before we do. My mandatory commercial. Still says March 17th. That's kind of annoying. Wait a minute. Boo. Okay. Fed says risks to the outlook remain. COVID continues to weigh on the economy. Market is not liking this. The rates are unchanged. The dot plot shows 7 people favor a rate hike next year. That's up from 4 in March. So they have moved much, much more towards tightening, which is what we expected when we started the week. I don't know why this is not refreshing. I must be doing something wrong. Federal Reserve Board news and events. Statement. There it is. Okay. So, all right, shush. That's the key thing. 7 people now favor the 2022 hike versus 4 people in March. So that's enough on the board to get a hike next year. That's just moved the rate hike up a year, and that's why the market's selling off sharply. So the Federal Reserve is committed to using its full range of tools to support the economy. Progress in vaccinations reduce the spread of COVID. Indicators of economic activity have strengthened. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Inflation has risen largely. Transitory factors are still staying transitory. Financial commissions accommodative, in part reflecting policy measures to support the economy and the flow of credit to households. The path of the economy will depend significantly on the course of the virus. Progress in vaccinations continues, but risks to the economic outlook remain. The committee seeks to achieve maximum employment inflation, 2% over the long run. Blah, 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 blah. Committee expects to maintain a accommodative stance until these outcomes are achieved. Committee decided to keep the target rate for the Fed funds to 0 to 0. Appropriate, maintain, reach consistency, blah, 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 blah. Federal Reserve continued to increase its holdings of treasuries by the same 80 billion a month. Nothing. If they change like 10 words here, I'll be surprised. These asset purchases foster the smooth market functioning, accommodative conditions, and support blah, blah, blah. In assessing the stance, the committee will continue to monitor blah, blah, blah. No changes. I don't even know why they bothered issuing another statement. Okay, so nothing, no changes, but what really has changed then is the data has changed. That's the key. So economic projections, that's where we are. Oh no, 2 p.m. Well, that's not fair. Wait, it is 2 p.m. Oh, projections, PDF. I guess. Ah, bastard. All right, so what are we looking at? Change in GDP, 7%, but then we drop down to 3%. In March, we projected, so they're projecting a better GDP, but the problem is it doesn't carry through. So I don't know where we're getting 7% when we're not at 7% now. Is the second half going to be that much stronger than the first half? I don't believe that's possible. That's a little bit weird. In 2022, we dropped down to 3.3, and then by 2023, we're down to 2.2, though. How is this sustainable? 1.8, this is shit. Unemployment is going to stabilize out at 4. So in other words, what they're saying is right now, we're about as low as it's going to get. PCE inflation, this is obviously some illusion that they're under, which is nonsense. But their March projection was 2.4. Now they're admitting 3.4. That's a 50% jump practically in inflation. You know, they're projecting 2 for the long run because that's supposed to be their job. And the core PCE inflation also went from 2.2 to 3 in the month. The Fed funds rate projections. Now here, this is very interesting. The projected appropriate policy path has gone from 1 in March to 6. Remember that half point I was talking about? There's 1,000 NASDAQ points. Have now negative 1,000 NASDAQ points has been projected since the last meeting. That's how you have to think about it. So they've made a very drastic change here on the inflation they pretend they're not seeing. And we know the inflation is much worse than that. So this number is going to get much worse than that. And a lot of people are putting this hike, or part of that hike has moved into 2022 now. That's what they're talking about, those dot plots. So our GDP was negative, minus 3% last year. And now it's going to be plus 6%, but that's from last year. That's a year-over-year change. So it really is as if it's going flat anyway. And then we go back to this flatness. This is not an exciting thing at all. And again, especially considering the massive amount of stimulus, this is all terrible, right? It cost us $10 billion of debt to get here. Unemployment rate has been very high, is smoothing out. Inflation is high. They admit that here, but they say it's going to come right back down because it's transitory. If they're wrong and it keeps going up, we're going to have a crisis of all sorts of things. PCE, same thing we were talking about. Here's that dot plot. And what's happened to the dot plot is everybody said we would be here in 2021, but now half of the people say we're going to be raising, I guess that's a quarter point. So I guess we're raising, half the people say we're going to raise a quarter point next year, half. In 2023, only a few stragglers, but most of the people say we're going to be up at least a half a point, possibly a whole point up. That point up is devastating. That's 2,000 NASDAQ points. So how many people think that? 3, 6, 8. 8 voting members of the Fed believe that we are going to have a 2,000 point NASDAQ adjustment, because that's what that translates out into. And then we're into this garbage, blah, 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 too wonky to go over. But it's good stuff to read. It honestly, I like reading it anyways. It's good. It's great reading. So that's where we are on the Fed. It's on the whole not a positive for the market, and that's good because we have that Nasdaq short still on, not the Nasdaq. I'm sorry, the S&P short we still have playing, but it's not devastating. What's the actual number here? 4223. Oh yeah, that's right. So the Dow's down 200 points. So basically down about a half a point on this news. That's pretty much where the indexes are hitting it. Uh-oh. My throat's going. All right, so ever since I had my shots, my voice is like not what it used to be. It's like if I talk for a long time, I start running out of voice. It looks like you're using an ad blocker. Damn right. I wish I could ad block everything. Freaking annoying stuff. So anyway, so now that we got the Fed out of the way, I don't mind. We'll go over the rest of the portfolios as far as in the member chat. We're going to get everything finished. And there was nothing drastic here, but again, it goes back to the premise, though, that the market is going to correct at some point. The market will correct because the rates will correct. The rates are incorrect now; they're too low. Rates will go back to a normal price. The market will go back to a normal price because the market can't return less than a 30-year note. That's the problem. And if they raise the 30-year note, the market's going to go lower until the earnings catch up. And the earnings are so woefully far behind. You cannot buy an index that's trading at 40 times earnings. It's just insane. Especially when a 30-year note is more than 2.5%, because obviously you're just throwing your money down the tube. And the problem is, unfortunately, though, that if the Fed keeps the rates down for too long, they end up discrediting the economy, hurting the dollar. It further impacts the rate of the bonds, and it'll cause the rates like this. What happened to Greece, because everybody lost faith in their actual currency, and all of a sudden they couldn't borrow the money at the lower rates anymore, and that sent everything else tumbling to hell. And obviously that's not going to happen to us, because unlike Greece, we can print our money. Greece was in a trap because they couldn't print their own money. They had to just rely on the ECB to help them if there was any help to be had. And the ECB was like, no, thank you. You guys screwed up your economy. Have a good time. I mean, it was smart because it was a good warning to everybody else to say, look what happens to you if you don't do things correctly. But on the other hand, it's devastating for the actual country that gets hit like that. And as I've often said, if nothing bad happens to Japan, who are 250% of their GDP in debt, we're only 150% of our GDP in debt. Japan's 250% of the GDP in debt. Until something really bad happens to them, I'm not too worried. But the difference is that we are not Japan, in that we are way, way, way bigger than Japan. All right. So in other words, if I have $5 million and Japan has $1 million relative economy sizes, and Japan needs $200,000, I'm in a position to give them $200,000 because I got $5 million. Okay. If Japan with their $1 million needs to give us $1 million, they can't do it. It's physically impossible for them to bail us out. But it's the same 20%. That's the problem. We can bail out Japan. Japan can't bail us out. The rest of the world can't bail us out. So nobody's coming to our rescue if things start falling apart. It's not possible to rescue the world's largest economy if it starts falling apart. We're just going to drag the entire world down with us. And that's what we got to watch out for. All right, anything else exciting going on? I don't think so. Let's just see if we have any before I go make some tea. Frontline. Forgot about Frontline. We added Frontline this week. That's a tanker company. And let's see if we, I'm sure they have an updated chart if we click on it. Hello. There we go. Oh, they're having a good day. Okay. So Frontline is way too cheap. I think we said they are 1.75 billion in market cap. Their net profit is going to be this year 100 million. Even 100 million though, that's only 17 times earnings, but they're going to crank back up to a reasonable $293 million in earnings, 300 million, even 200 million though. I'd be thrilled to own them. And we took a very conservative position on them, but I like this a lot. This is a brand new trade from yesterday. And then we had Two Harbors, who I like as a REIT, and they're trading in a good range, so we picked them up also. 753, they're down a little since then. AIV is an apartment REIT. How are they doing? Oh, we didn't do the thing on them. AIV was from last week. Oh yeah, holding up strong, good. And Philip Morris, I think we talked about already. I don't know if we talked about it. Did we talk about the AIV? I think we made that trade during the webinar, didn't we, or something? I don't remember. No, it was before the webinar. Anyway, also lovely. So these are the kind of trades we're getting into now. Like, we're not going crazy. It's SunPower as usual, US Steel, Rio Tinto, Philip Morris, or Altria, whatever they call themselves, AIV, Two Harbors, Frontline. You know, I'm trying to stay away from things that are going to get caught up in the inflationary cycle. In theory, we could get a benefit for the real estate market. Shipping, as we know, is huge and everything's out of control, and the shipping container prices are through the roof. Oh, where is it? Is it the BDI? Baltic Dry Index. You know, this is a proxy for the shipping rates, and if you look at where Frontline is, here's the normal shipping rates, 1,200, maybe up around 2,000. We're at 3,000 now for dry containers. But they're, you know, it just gives you an indicator of how busy shipping is and how expensive these things are. That's all profit for them. They got the same ship with the same everything else. It's not like their costs are running up. Their fuel costs are really bad, but generally the cost to run a ship is X, and even if the fuel charges are going up, it's not going up that much. And so they are just cleaning up. So I really like all these shipping companies are looking kind of interesting right now, just because we're so busy. And that would include like FedEx and UPS, but they're not cheap. You know, FedEx is historically up there, and UPS also, I think. There's one called Atlas, I think it was. Those guys seem like an interesting play. Let me see that. Atlas. Atco? Or is it Atlas Air? Atlas Air. That's what I'm thinking of. Atlas Air. Yeah. They caught my eye, but I don't think it was a problem with the options or something wasn't really gelling. But if I remember correctly, they had pretty good numbers. So Atlas Air is only a $2 billion company. They're air freight, and yeah, and see they can make. You know, they're going to make $300, $400 million on a $2 billion valuation. I like those kind of companies. 7 times earnings. That's not bad. And you know, I remember I was reading about they were kind of marginal. I think it was that the options weren't particularly exciting or something like that. Otherwise, I would have picked them because I kind of like them. They're in a good spot. They're in a good sector. This is what, and, you know, this is what you want when you're picking a company. It's like, I want a company that's in a good sector, that's got some growth, has some tailwinds, is right for the economic climate. Let's see, profile. So aircraft aviation operating, charter, dry leasing, outsourced cargo, passenger operating, all kinds of, you know, a lot of avionics, but not, that was one of the things. It wasn't as much. I thought they were more of a freight, and they're not as much of a freight as I thought. They're working passenger, but still, I think they're a good company, nice going forward. They're making good money. They're going to probably make a lot more money. It's just been a tough year, but they got to, you know, I mean, but if this is a tough year for them, and they lose $300 million, they recover. It's not like they're desperately in debt going forward. In fact, if you look at their quality scores, bankruptcy cautious, but the health trend of the company is like way up here. So I do think it's a one-off thing. They had a tough year. They're over it. This wasn't even 2020. I'm sorry. That was also impressive about them. This was 2019 that they lost some money. So for whatever reason, they did something in 2019 that caused them to take a loss. 2020 wasn't even a bad year for them. That's what's cool about this company. So I like playing companies like that. They're very interesting. And that's the kind of thing we've been doing. I've been going over lots and lots of companies. This week I got to do the portfolios, but I've been going over a lot of companies, just looking for needles in the haystack that are good bargains. And it ain't that easy in this market, but there are things out there worth buying. And just in case the market never does crash, we have to keep adding some fresh meat to the portfolios. That's all. All right. So before my voice gives out completely, I'm going to call it a day. Tom is asking, if the dollar is up 50 cents, will oil fall? If the dollar is up 50 cents, the dollar is not going to go up 50 cents. That'd be crazy. The dollar, 50%? Whoa, look at that. That's from the Fed, though. The Fed is going to tighten one day. Therefore, the dollar has become stronger, and that's knee-jerked everything down. So really, honestly, the move in the markets down is not that bad, considering the dollar pop like that. And, oh, did that give me my energy price right to go? Ah, damn it. I would have hoped that would have hurt oil more than it did. So considering the dollar took such a big pop, these numbers aren't bad so far. Look at the bonds. Because rates are going up. That means the bonds you currently own are becoming worth less. If the future bonds are going to have a higher coupon, then the bond you have now is going to be worth less. You'll have to discount it in order to get rid of it. That's how the bond market works. How's everything else doing? Coffee's holding up. That's a good sign. Gold and silver taking a direct hit from the dollar. That's not unusual. Grains, or whatever they are, grains, oats, canola, nothing exciting there. And that's cool though. Wow. So I'm sorry. So let's see whether that, now that question has more validity. If the dollar's up 50 cents, will oil fall? The oil and the dollar are usually well correlated. I guess he meant the 0.5% or something like that. But yeah, oil should fall, and I'm surprised it's still holding up so well, frankly. But again, you know, it's the July 4th weekend. But I really can't believe we're not going to hit 71 again this week. There's nothing that exciting in that oil report, but I can't chance it over the weekend. It's out of chances. You know, it's like we were hoping it would sell off. It didn't sell off. End of story. Got to walk away until after July 4th. If they hit 75 on July 4th, though, God bless. I'm going to go short and go back to USO shorts and do whatever the hell to play oil down again, because I love that trade when it works. When it works, I love it. When it doesn't work, it's not as much fun. All right, thanks for coming, everybody. I hopefully have a better voice next week. So we'll do it again. Thanks. Take care.